All right, so I've been gone for a few days at basketball camp and going for a few days here next week as well. So in between, I get a day here to do the market outlook, kind of give you a take on what's going on. And we've had quite the rally. There has been some very interesting and unique patterns. I tweeted out a few on Friday as well, but some very unique patterns that you just do not see very often in terms of just how bullish we've been. So I'm going to break down what those patterns are, what the markets have done after we've seen those patterns before, kind of what we expect we'll see from the markets here, and what the options market may be telling us in terms of why we've been rallying into this options expiration, and what people may be expecting based off of options pricing, not just in the near term, but what kind of moves they're expecting. So we're going to break all that down. Some very interesting patterns going on, especially as it relates to inflation expectations. We might be hitting a big news from the sentiment standpoint. Sentiment survey that inflation expectations dropped to their lowest levels. This might be the lowest level that we see inflation drop to. As we get to not this next month, this July release that we'll get next month. Might be ultimately the lowest point. So we'll talk about that and why, and the significance that will have, and what will happen with equities now that we start to draw down some liquidity, and what that's all about. So we'll break all that down with our trade idea of the day, taking a look at a stock that's been in the news itself, at least associated with cryptocurrencies. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, June the 16th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our website, check out some of these other things over here on the right. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that for us, that helps get our content out to all of our followers. That's all we always ask for it every day. Thank you, those of you who do like us day in and day out there. Those who don't, you can do right now with one or two really easy clicks while you're watching. All right, let's take a look at the S&P and how it closed out the week here. You can see it closed. We have been going parabolic and finished the week on a small down, a very, very small near-term line, still in the bullish territory, though it's out of the upper reversal zone after a few days of declines now. The momentum line sticking around neutral territory, not really bullish or bearish. The long-term market sentiment has crossed up above the 80th percentile, so you have both the long-term market sentiment line and the intermediate line both in the upper reversal zone, so showing a bullish pattern there. Strong rally, up to about 5%, over 5% above the 30-day moving average, which is not extreme. You can see it's not in the past year. You've had other peaks, notably the August peak, the February peak, and even this November peak that got higher than that. But still a pretty decent end of the week. Also an end of an expiration cycle we'll get to in a minute. Here's the weekly chart. You can see you still, after getting a cluster 2 weeks ago, you've gone well above that cluster peak. You've now finished above this August peak. You kind of finished above it last week with a very, very small range. This week was a large range, much large, 144 points, more than double the range of last week, and more than the week before that had the cluster, more than that 108-point week, 103. You can see you have to go all the way back to right here, the last week in March, where we had a bigger range than what we had this week. Again, now 8.5% above the 30-week moving average, which again is not that large, but it is the highest point than even right before the correction started. You have to go all the way back to over here at the early part of November. Again, we talked about this is also the end of a expiration cycle. So when you look at the expiration cycle, you can see again the near-term line making a much farther move into the upper reversal zone than the momentum line ever got, and it's already coming down But you can also see too the strong expiration cycle we had. So we were sitting at Fibonacci levels here, 23% retracement of the post-COVID rally, and then big breakout this week above these August peaks. So really, really good month when you look at this on a monthly chart to get above these August highs pretty clearly too. Not even close, not even just a little bit. So good strong kind of parabolic move here. You'll see when we look at some other indicators to finish off the week. The Nasdaq also continuing its strength, though again momentum line not quite getting up there, and a little bit more bearishness on Friday, but still strongly above the 30-day moving average. Momentum line dropping down into bullish territory. Remember, the Nasdaq's been bullish since a lot earlier. It's been now over 3 months the Nasdaq's been on this intermediate run. The Russell 2000 just barely started its intermediate run last week, and it had a kind of a middling week. It had such a strong week last week. This week, it's kind of stuck, and it's been up and down, up and down, up and down, finishing on a down note. And then finally, your Dow Jones Industrial Average also trying to get above this August peak and November peak here, trying to get through these levels. That's been sideways for so long, and so far unable to do so. Going into this expiration. And we've seen other expiration cycles, August notably, the August cycle where we were really bullish going into the expiration. Then we pulled back. The February move also is a pretty strong move through expiration before pulling back. This was, you had a little bit of weakness right at the beginning of the expiration cycle, and then it's pretty much been bullish ever since that bull tag. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 days. You've had a 16-day rally here. If I were to change its rate of change to 16, so you can kind of see how big of a move that's been since that bull tag pattern. You're at 7.5%, which is higher than these other moves, higher than the parabolic move that only got to 6.64%. Not quite as high. The August peak had gotten nearly 10% in 16 days. But again, still a pretty darn strong move heading into a resistance level. You had a pretty decent move here in April going into that expiration, and you were pretty flat for most of the May expiration cycle. And then there's the one going into February that we talked about. So one of your stronger runs into an expiration cycle to the end. Not one of the biggest moves, though, for an expiration cycle. When you look at this chart here, and let's just go all the way back. Change this to maximum available, and we'll go to options expiration cycle. You can see it wasn't like we had pulled back just a little bit there. So we finished with about a 5% gain, just under 5% gain. So again, this is the third straight cycle, and 2 cycles ago we were at 5.69%. So there's the August cycle. The August ended up being over 9.6% going into that August expiration. Now, granted, the VIX was a lot higher, 24% there, versus the VIX going into this month was only at 17%. So but still, it's a pretty good move considering how low the VIX was going into this options expiration cycle. In fact, when you look at the VIX chart, let's go to this chart here and pull up this one. When you look at the VIX chart, you've had, as we mentioned, quite a few months in a row now of significant declines. These are really, really big moves to the downside in just a matter of a few months. So that's the kicker. Some of these other expiration cycles where the S&P was so bullish, the VIX started at a much higher level, and hence you get bigger moves, and the VIX starts at a higher level. The VIX was starting this expiration cycle at such a low level that it's surprising how bullish we were, especially considering we're not starting an intermediate run, that we've already been on one now for a couple of months here, and on the Nasdaq for now 3 months. So it makes you question just a little bit how bullish this was, especially when you start looking at some of these other indicators. Looking at the weekly chart, you can see again about as strong of a weekly candle as you get. Follow my cursor all the way to the left. It generally doesn't get bigger than this. And remember, bullish candles tend to start intermediate runs with big candles. And here we are again, already on one, and you're getting one of the bigger candles that we get. This is actually a 3-period average. So the last 3 candles, the average is pretty high. Again, that's typical of starting an intermediate run, not one that we've already been on. The PPO is up to a pretty decent level, going back again to pre-correction levels there. Of course, your NASDAQ 100, not as bullish, though that right before that it was. Remember, we've been bullish for so long. You can again see how big these candles are. I mean, that's such a strong, again, I'd be a lot more bullish about this if this were early in the cycle, not so far along in the cycle. That tends to, you start to get transition candles because it's hard to maintain such strong levels of bullishness. You do have 3 green arrows all across the board. Easy trends going on now on the Dow and the Russell as well. They were the last ones to start these 3 green arrow trends. Your S&P 500, you can see how far up above like the 30 and 50 day moving averages they are. If you look at the weekly version of this, now that we're finishing off a week here, again, pretty strong bullish move from a momentum standpoint, higher momentum now than what you had even pre-correction. So pretty strong momentum levels there. And then looking at the expiration cycle that ended, again, you can see just how bullish this is. Just barely went bullish. And then now, like I said, crossing above that 23%, also crossing above the 62% and the August peak. So pretty significant Fibonacci breakout moves if we're able to hold them on the S&P 500. Looking at some of these other indicators, again, you can just see how parabolic of a move this is. Like, it's so uncommon. It's so uncommon for the S&P to get a DMI positive above 40 and below 10 at the same time. You can see it hasn't been, the negative indicator, hasn't been below 10 in the past year. And the last time it got below 10 was right there, that parabolic move that it had going into September 2020. We had that drop. That was the only time here in the last, 5 years that we had the negative indicator drop below 10. So again, that shows how rare it is. You can find some other instances further back, but they didn't have the positive indicator up above 40. So here's another one there in 2018 where the negative indicator got below 10, early part of 2018. You can see another couple instances here in February of 17 and pretty close to that there in January of 17, and then that's it for the last 10 years. So you just see how uncommon it is. Then you add on to that how strong the RSI has been. So when you go to the RSI, we got above 75. Again, you look at that 2020 level, you were well above 75 at that point. And then, as we mentioned, early part of 2018, again, another instance where the RSI got pretty strong. And then 2017, this early part where the RSI got pretty strong. So here we are again with this RSI that got above 75 yesterday on Thursday, with a declining, with a divergent CCI that's forming there. You look at the McClellan oscillator, and you can, from a breadth standpoint, you see, okay, well, we're so strongly bullish, we should easily be above positive 35 and really be starting this trend. It's like, we're not. We have not been able to really clearly get some strong momentum going to the upside. We never really could get it going to the downside either. Hence we were so sideways. But again, we can't get going. You can see all these other trends that get started at getting above 35, and that just isn't the case right now. So that's a little bit of an issue, especially, it's one thing to not be so bullish when you're already, at strong levels. You're not going to have strong levels above 35 when your summation index is above 500. But here we are not above 500, and we can't get going to be able to get to that point and get up to that 1,000 level, which really solidifies the trend. Looking at some of the other indicators, when you look at the whole moving average, you can see now, we've been so bullish. You got higher close, a higher high. You can see we're starting to diverge with how big the daily candles are, and the parabolic SAR is so close. So you're getting to the point where you're starting to lose, and you're so strong in the momentum. you're starting to lose some of that momentum. Looking at the Bollinger Bands and the Keltner channels, this is something that kind of stood out too. Again, you're still above the Keltner channel, strong momentum, still well above the Keltner channel, still in the upper quartile of the bandwidth. But if you were to zoom out on this and take a look at the options expiration cycle. So this is the first expiration cycle that let me get rid of that expiring cone, that we have closed back above the upper quartile on a monthly basis, so on the options expiration cycle basis. You can see when you get bull markets, or bear markets, excuse me, everybody thinks this was a bear market, right? Well, when you are in bear markets, you get into the lowest quartile of the bandwidth for multiple months, like there, like over here. If you go to SPX, we can go back further. You can see over here an expiration, a bear market, and you can see right there bear market, and over here bear market. So multiple expiration cycles where you're in the lowest quartile. When you get corrections, like we've seen here with COVID, and like you saw here in the fourth quarter 2018, and here in 15 and 16, and then 2011, you only spend really one expiration cycle down there, and then you bounce right back up to the midpoint, at least to the midpoint, and then beyond. So that's, in this case, you only had one expiration cycle here in May to June where you were in the lowest quartile of the bandwidth. That was it. Now, it took a little bit longer to get to the upper half, but we did. And then now you're in the upper quartile. So again, this another characteristic, this was just a correction as of right now, more so. And you're starting what could be a long bullish. You see, you get in the upper quartile, you stay there for a while. So this could be a long move to the upside, or it could be a dramatic fake out if this ends up coming back into the lower half of the bandwidth by the time all is said and done here. Again, you look at the volatility indicators, and we talked about this, finishing the week at nearly its lowest level. And here you can see the VIX had a negative correlation. I pointed that out to you. The VVIX has been ramping up. The VIX has been down at such low levels here. But when you also look at the VIX and its correlation with the S&P 500, which is typically an inverted correlation, it actually went briefly positive on this. Here, let me change this so you can see the SPX on this chart. So it actually went briefly positive, where there was a time where they both kind of went up in a positive correlation, again, over a 2-week period of time. That's not very common, and generally speaking can lead to especially when there's negative correlation with the VVIX, can lead to a rise in volatility, especially at low levels, and you're closing at such nearly extreme lows. 80% is the extreme low for this ratio of VIX to VVIX. As of right now, you are still with a very strong Arun pattern. The positive, the negatives already hit 0. The positives got to get below 70. You've had a big run up in the range, not quite up to the 10% mark, but well off of the lows that it had. So you've had a good run up here, and you've had a decent amount of volume and trading range over the last few days. Big amounts of volume here. That's helped the money flow improve to a large degree. You can see the money flow pattern getting up to these high levels, but again, you can see this is about the levels when the money flow index gets up that it tends to run out of gas, right? Especially considering the money flow on an absolute basis made quite the run to get back to levels it hasn't been to since over here. This is the last time that the money flow index was at this level, and obviously the indicator, the S&P itself, is way off of those lows. So that kind of goes to show that we haven't had a whole lot of volume on the rallies, even though we're way off of the level the last time we've been to this point. And really, it's been the last week that we've gotten to this point. A very strong move in volume over the past few days. There's been a lot said about that because you get to the gamma exposure sites of how much call buying there's been. And you can see you've had, up until the Friday, you've had a very large level of retail buying of call options. You see that as well in the put call ratio and I've got the 5-day average here of the put call ratio. That'll come up here in just a second. Here you go, and you can see it's at low levels. Again, last time it was in August that it was at this level, but we are getting much better breadth from an S&P 500 standpoint. You're at well above the 60% mark. You're at 70%. We were there here in February as well. Not quite above this 80% mark, but still, that's better than we've seen in a very, very long time. Here is the number of stocks that are below their 50-day moving average by 5% or more. We're back to kind of extreme lows, that one standard deviation move to the downside. And then finally, the last thing we look at on this chart is, let's see, no, not those. It's this one, the average deviation away from price deviation, and we're up at that one standard deviation mark. Again, August peak was well above this. The November peak was even higher than that. The February peak we're 6% above, so we're not quite at those levels, but you can kind of see the resistance mark that we're at right now. Now the question is whether or not we can actually push through, especially coming out of expiration, coming out of this expiration cycle where a lot of these options, this enormous amount of call buying and volume has been purchased on a retail basis going into expiration. Is that going to continue, or is it going to start to unwind? A lot of times when people buy call options, market makers sell those call options to the buyers and then hedge those short deltas with buying S&P deltas, right? With going long S&P deltas, and that pushes stocks up, as we've seen. Plenty of liquidity to be able to do that here. We all know liquidity will be drying up as we go along over the next so many months with the Treasury general account getting larger again. So there's going to be an issue, and the Fed's balance sheet still declining. So there's going to be an issue with liquidity, but while we still have had it, there's been a large ramp up in call buying, and the equivalent gamma exposures help push the S&P up very strongly, as we saw, considering the VIX, the low level of the VIX to begin the cycle with, into this options expiration. And now that we're through, how's that unwind going to go? And you would expect that it's not going to go too well for the S&P coming out of this long holiday weekend. As we take a look at what's driving the price action here, again, you can see the parabolic move the Qs have made over the past 3 months, over 20% gain, obviously bringing the rest of the market up. The emerging markets and small cap stocks kind of joined the party here late. They had a very small gain while the Qs were up over about 15%. They were barely positive at all, but they've really rallied here late to catch up with EFA, which has been lagging, which actually had been outperforming S&P. The S&P kind of overtook that. And of course, gold and bonds, not surprising, dropping. Commodities really taking off in the past few days. If you take a look at the commodity ETF, DBC really jumping up in 2 days, rallying above the 50-day moving average for the first time in a few months when it made a rally here in early April. It's been declining ever since, but a strong run. This has impacts on inflation expectations. I wanted to bring this up here as we are now at the end of an options expiration cycle. When we take a look at the 12-month pattern here for like commodity prices in particular, like gasoline. So gasoline was down here. Let's actually go to, since we're almost done with the month, to the monthly candle. So you can see we were down 38% year over year for gas prices going into this cycle in May. But you notice here in August, when you get to May, that was the highest peak that we're coming down from. So that will be the lowest level now that we're dropping from that May peak. That will be the lowest level that the year over year decline of gasoline prices will have. And you can see similar on crude oil too. Crude oil this last month here in May finished down 41% year over year. But again, that May peak right here was the last highest point. So as it starts to drop, as the basis starts to drop, then you'll naturally start to rally a little bit here, and it won't take long for gas prices to rally back to actually to be in positive. You can see from the August low point, the end of August, we're actually above that level. So just in a couple of months, we'll actually turn positive, and we've been talking about the same thing with inflation. How inflation here, the year over year, the month over month rate peaked in June. When we get this up here, there we go. So when you look at the month over month rate, the highest peak was in June. So in July was actually a negative number. So the year over year rate will peak with the June release that will be released in July. The June numbers released in July. After that, and we're expected as of right now to get down to 3%, close to 3% in that June release. So the CPI is actually now, it's actually been ramped up to 0.42%, but still it's expected the year over year rate to get down to 3.22. Again, this is the June number is going to be released in July, 3.22%. Now the core is still, it's going to be stubbornly high, above 5%. That's, we can't quite get that down below 5% there, and the core PCE is going to come down. It's right now at 4.8. It's expected to get to 4.44 by June, but that's the lowest level that we'll get to. The year over year rate will get to, because the month over month rate the month over month rate will have a better basis starting with the July release. So you're going to start seeing year over year increases of about of 3 to 4 5%. So we'll ramp back up to 5% by the end of the year, which means that the real Fed funds rate, which finally turned positive here for the first time, if we're gonna the overnight rates widely expected to get to 5.5% the next meeting in July. Of course, things can change, but with their last statement or last press conference, they pretty much put on the idea that they should hike again. That it was just a skip at this last meeting. They're ready and willing to hike again a couple more times for most participants by the end of the year. So that puts this July meeting on the table, and there's a 75% probability of a rate hike by then, getting to 5.5%. And if you look at December, you have about a 55% chance of us staying at 5% by the end of the year, 5.5%. So if the inflation report starts to move back up to 5%, then you're going to see this drop back down to 0. Remember, the Fed's goal is to get this to about 250 basis points and keep it there, which was the typical regime back in the past. It was only since the financial crisis that they've actually had a negative real Fed funds rate policy for years. And anytime it went positive, they either stopped raising rates or they had a rate cut cycle. So this time, obviously, they're not going to be cutting rates anytime soon. But they might end up having to raise rates again by the end of the year if inflation starts to ramp up. And as like I said, that gasoline contract, crude oil prices, the commodity prices ramping back up, as it does this time of year, you would expect that that's going to have an impact on inflation going forward and start to raise up the 10-year yield and work its way back above 4%. And work closer to that 5.5% where the overnight interest rate is. TLT, remember, bull markets don't start, like long-term bull markets don't start with TLT this far below its 200-week moving average. Long-term bull markets and equities start with it well above its moving average, right? Anytime you're above the moving average, you get a good rally in equities that can get started. And generally, equities peak when TLT is below its moving average, which obviously was the case or is the case right now. And at some point in time, the TLT is going to break through and start to move higher. If equities move higher with it, that means inflation. That's an inflationary environment. Inflation will start to ramp up. The Fed will start raising rates again, and at some point in time, the typical cycle that will lead to, to just higher borrowing costs and reduced aggregate demand, and and then everything that goes along with that. But if bonds go up and stocks drop, that means we're in a deflationary environment. Obviously, that's recession, right? That's pretty much the so. If and when bonds start to rally, you can see it's been basing. You've got the head and shoulders pattern. At some point in time, bonds are going to fill in this tremendous. This is the lowest TLT has ever been, the lowest 200-week moving average. At some point in time, it will start to fill in that gap because that's what things do. That's what anything does. It starts to fill in that gap, and you would expect, I would expect that stocks will not rise along with bonds. That it would be the other way around, and that will generally lead to a volatility event, and that's the markets have been preparing for that. In fact, if you look at the skew has been above 150. It dipped its toe on Friday below 150, but this skew over this past couple of weeks being easily above 150 suggests that market participants are looking for big fat tail risk, right? For bigger moves, similar to the correction that started in 2022. The last time the skew was up this high, the skew got above 150 in anticipation of the correction that was beginning. And the MACD of the PPO wasn't nearly as strong back then as it is right now. And so if you're going to get a drop in the skew below its moving average at a higher level since that point as well, then again, that's another sign that with this parabolic move we've been having, the strong volume, the kind of exhaustion type move that we're getting right now, maybe on its last legs. Let's look at the sector rotations. And you see the sector move that we've been seeing here. I showed you before that, how the three at the top were dark green shading a green line and everything else wasn't. Now everything is pretty much dark green shading in a green line. The only things that aren't are utilities and staples, and that they're at least a yellow line and light green shading. So they're giving us these bear tags here. These would be either the beginning of bullish moves to the upside or bearish bounce, right? Bearish resistance bounces. Healthcare has the same pattern, but at least has dark green shading with that yellow line there. But everything's really turning up. And when you look at the relative rotation graph, let me close some of these so we can see this a little bit better. When you look at the relative rotation graph here for these S&P 500 sectors, you can see the three continue to have the strongest relative strength on a weekly basis. Healthcare, utilities, and staples are moving down to the left. Financials, industrials, energy, materials are moving up. In fact, financials now is kind of joining the party in terms of momentum. That these three not only have the highest relative strength, but they've had the highest momentum as well. But now things are shifting, as you notice on the daily chart. The highest momentum moves are in utilities, staples, and healthcare. I mean, they're really starting to ramp up momentum standpoint. Technology, communication services really losing strength down to the left. Industrials has been doing okay. It has materials has really been kicking butt. But you can see they're kind of starting to stall. Discretionary as well, kind of stalling. Financial stalling, energy stalling, real estate stalling. Real estate and discretionary kind of joined the cyclical group. So it seems like they're stalling, and now it's these three safety areas that are moving up to the right as we approach what may be a parabolic peak here. Like I said, a very rare combination of overbought signals when you look at the DMI negative indicator being below 10, the positive being above 40, and the RSI itself being up above 75. And if you look at the weekly version being above 69 and the CCI getting above 200. So lots of kind of rare, extreme overbought signals as the market itself is pushing towards safety right now. Like the safety areas are starting to gather some momentum, and then your kind of large mega cap names are losing their momentum. One more thing I wanted to show before we look at our trade ideas, again, how strong the Qs have been, again, higher than any cycle during the COVID move. Getting above 1.9 again for the second time in the last 4 weeks, nearly above 2, finishing the week nearly above 2. It's MACD higher than it's been. Higher. The only time it's been higher is right during the COVID move, and you can see the MACD and stochastics. They already had peaked. The momentum peaked here. The MACD typically peaked after the histogram. The CCI has already peaked. You can see the ADX is looking to peak here as well, and the same thing with the rate of change and the RSI peaking again. This is on a weekly chart. So a very parabolic move here on the Qs relative to IWM, and that continued this week. Again, going into expiration. Now the question is, how will the Qs do now coming out of expiration there? For our trade idea, I wanted to take a look at Coinbase. So if you look at Coinbase here, you can see it's been pretty it had a bearish trend initially. It had a bullish bounce. We've gone through a couple of earnings cycles pretty sideways for the last so many months. You've built up a pretty big volume node here in the middle of the chart, the point of control, right smack dab in the middle of that value area. Pretty much one big volume node. Lots of volume right in this area, up and down. We've gapped down a little bit a couple weeks ago. We've been filling in the gap since, but to a small degree, nothing too major. You can see all the moving averages pretty much sitting on top of each other and all pretty much going sideways, maybe slightly up, maybe slightly down, but no significant move. As you can see, the MACD and stochastics are kind of trending near the middle of their chart. The DMI, same thing. When you look at its DMI, it's not really doing much of anything. Both lines right around 25, but not trending in either direction. Looking at the RSI, they're both right in the middle of their charts. The Bollinger Bands and the Keltner channel. You can see right in the middle of its bandwidth, and that bandwidth was going up. It's looking like it's slowly starting to decline, with the band still inside the Keltner channels there. Looking at the long-term chart for Coinbase, and you can see you've got a red arrow last week, and you got a little bit of a bullish candle, but not really much of one. Definitely not getting below last week's low point, and not very big of a candle either to get us going. So not very much of a move going on at all on the stock, and like I said, centered around a big volume node here in the middle. So what I decided to do was, let's come to a single symbol, was to sell the 45 and the 70 options here. So sell the 70 call option for July, buy the 45 call option, so right around the low 20 deltas on both of them. Go one strike away, go for a full position size, and you can see what the break-evens are. The break-evens are essentially outside of this range that we've been in for the last so many months. So as long as we stay in this range, we can maintain, and it appears as things have been kind of steadying, and there's a good chance that we will fill in that range, since and that's kind of the point here. And if it breaks out one way or the other, then we'll be breaking out either to the upside or more likely to the downside. Either case, you'll be looking for a directional move in that case, and be willing to take not the full $1,000 loss, but at least $400, or most, $400, considering that's the credit we're trying to get on this trade. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next week.